Have you ever looked at your bank balance and wondered where that money actually is? Is it in a vault, in a neat pile with your name on it? The truth is, it isn't. And this isn't some conspiracy theory. It's the fundamental design of modern finance. If every single person tried to withdraw their savings tomorrow, the entire system would freeze. Banks simply wouldn't have the cash to give everyone. Most of that money doesn't exist in physical form. This isn't a flaw in the system. It's the system itself, built intentionally over centuries. We operate on a structure where money is created from promises, not from physical assets. This design quietly drives debt, fuels inflation, and creates the feeling of growing wealth even when real value isn't necessarily increasing. To understand this, we need to travel back in time to an era when money was something you could actually hold. In medieval Europe, wealth was gold and silver. It was heavy, risky to carry, and inconvenient. So, people started storing their coins with goldsmiths who had the strongest vaults. In return, they received a paper note, a receipt confirming they owned that gold. It didn't take long for people to realize it was much easier to trade these paper notes than to lug around heavy metal. The paper became the money. Then came the light bulb moment for the goldsmiths. They noticed that most depositors rarely, if ever, came back to claim their actual gold. The vaults stayed full. So, they started issuing more paper notes than the gold they actually held. They could lend these extra notes out and charge interest, making a profit on money that didn't really exist. As long as everyone didn't show up at once demanding their gold, the system worked perfectly. This was the birth of what we now call fractional reserve banking. This clever model didn't stay with goldsmiths for long. Governments saw its potential. Institutions like the Bank of England were established not just to serve the public, but to fund state expenses, especially wars. Money was essentially loaned into existence to cover government spending, with the promise that it would be paid back through future taxes. This became the blueprint for national economies around the world. A similar story unfolded in the United States. Early banks issued far more paper money than they could ever back with gold or silver. When public confidence wavered, people would rush to the banks to get their real money, leading to bank runs that exposed the system's fragility. But instead of abandoning the model, governments stepped in to save it. They created central banks to act as a lender of last resort and, more importantly, to manage public trust. Today, this process is even more abstract and operates at lightning speed. When you deposit $100, the bank doesn't lock it away. It's required to keep only a tiny fraction of it on hand. The rest, say $90, can be loaned out to someone else. That $90 loan then gets deposited into another bank account, and that bank can then lend out a portion of it, and so on. The original deposit is multiplied again and again throughout the economy. The vast majority of money circulating today exists only as digital numbers on a screen, backed by debt. In fact, in some countries like the United States, the reserve requirement has been dropped to 0%. Banks are no longer limited by the physical cash they hold. Instead, their lending is governed by international rules about capital and liquidity, like the Basel Accords. These regulations are meant to ensure banks have enough of a financial cushion to absorb losses and survive stressful periods. So, here's the key takeaway. Modern banks don't lend out money that's been saved. They create new money every time they approve a loan. When you get a mortgage, that money isn't transferred from someone else's savings account. It's created out of thin air, appearing as a new digital deposit in your account. That money exists because you made a legally binding promise to pay it back, with interest. This means most of the money we use every day is privately created by commercial banks, not issued by the government. This structure has several inevitable consequences that affect us all. First, inflation. The more money and credit that gets created, the less each individual dollar is worth. Your purchasing power slowly erodes over time. Second, the system requires permanent debt. Since money is created as a loan with interest attached, there is always more debt in the system than there is money to repay it. It's a mathematical certainty. Third, this system concentrates wealth and influence. Financial institutions earn massive profits from interest on money they create. Governments can fund spending without the immediate political pain of raising taxes. And those who own assets like real estate or stocks benefit as prices are inflated by all the new credit, while wages for the average person often struggle to keep up. History is filled with examples of what happens when this cycle gets out of control. The financial panics of the 19th century, the Great Depression, and the 2008 global financial crisis all followed the same script: a massive expansion of credit, followed by a sudden loss of confidence, defaults, and then massive government intervention to prevent total collapse. Different countries have slight variations on this system. Some emerging economies might use higher reserve requirements to try and control lending. But globally, the core principle remains the same. Money creation is fundamentally disconnected from physical deposits. Here's the uncomfortable truth: our entire economic system depends on continuous borrowing. If everyone were to miraculously pay off all their debts at once, the money supply would shrink dramatically and the economy would grind to a halt. The system requires constant motion. It needs new debt to keep the wheels turning. So, what does this mean for you? It means that real wealth isn't just about the numbers you see on a screen. True wealth lies in productive assets, skills, knowledge, and resources, things that have tangible value outside of the financial system. Understanding how money is created helps you see why debt shapes our lives, why inflation is a constant presence, and how to make smarter financial decisions. The goal isn't to be fearful, but to be aware. When our money is created from promises rather than substance, the stability of the entire system rests on one fragile thing: confidence. And as history has shown us time and time again, confidence can be broken. Thanks for watching. If you found this explanation helpful, please consider liking the video and subscribing to the channel for more content that breaks down the complex world around us. See you in the next one.